In July of 2012, Mark Zuckerberg bought a $5.95 million home in Palo Alto, just a few miles from Facebook's headquarters. He didn't pay cash. He took out a 30-year mortgage. At the time, he was 28 years old and worth an estimated $15.6 billion. On paper, he could have bought that house and several more like it without even noticing the money leave his account. So what would make borrowing the smarter move? This is where common sense breaks down. For most people, debt reduces freedom. It adds pressure, it narrows options. For him, it did the opposite. While ordinary borrowers work hard to eliminate loans, some of the wealthiest individuals intentionally keep them. And over time, that choice makes them more stable, not more exposed. The usual explanations, discipline, intelligence, confidence, don't really explain this gap. What matters is the structure underneath the loan: interest rates versus inflation, income versus assets, cash flow pressure versus balance sheet flexibility. When borrowing costs less than money loses value, the math quietly flips in the background. If you're new here, I'm Alex. Today, we'll break down how the wealthy are able to live on loans without stress, why banks are comfortable with it, how the structure keeps risk low instead of high, and why copying the surface behavior without the foundation almost always backfires. Now let's start with the one question banks care about more than anything else: how banks actually decide who is safe. Banks don't start by asking how hard you work or how impressive your salary looks on paper. Their first question is much colder. If this loan goes bad, how easily do we get our money back? That single question explains almost every difference you see in lending. Take two borrowers. One earns $180,000 a year, but owns very little. The other earns far less on paper, but controls a portfolio of stable assets. When markets tighten or income dips, the first borrower becomes a problem overnight. The second barely registers as a concern. This is because banks don't really lend against effort. They lend against recoverability. A job can vanish in a month. A diversified portfolio or prime property rarely does. From a bank's perspective, assets are calmer than people. That's why someone with substantial assets can borrow millions with minimal scrutiny, while someone with strong income still faces strict terms, higher rates, and rigid repayment schedules. The risk isn't emotional, it's mechanical. Once lending shifts from income to balance sheet, the relationship flips. The bank isn't betting on your future behavior. It's temporarily unlocking value that already exists. And that subtle shift, income versus ownership, is where the entire debt story quietly changes. Why consumer debt is structurally fragile. Consumer debt feels normal because it's everywhere. Car loans, credit cards, personal loans, even mortgages. But structurally, this type of debt is built on one weak pillar: your paycheck. Picture a household with a $2,400 mortgage, a $480 car payment, and a few thousand on credit cards. Every month, the clock resets. Miss a paycheck, and the entire structure wobbles. Miss a few, and it collapses. That fragility isn't accidental, it's priced in. Banks know income can stop instantly. Layoffs happen, health issues happen, industries shift. So consumer loans come with high interest, strict terms, and zero flexibility. If payments stop, the loan breaks. No patience, no renegotiation, just enforcement. The hidden pressure comes from how this debt is serviced. Payments are made with after-tax income. You earn the money, pay income tax, then send what's left to the bank plus interest. You're losing on two fronts at the same time every single month. From the outside, it looks like debt is the enemy. But here's the uncomfortable part. The structure is the problem, not the act of borrowing itself. When debt relies entirely on future income to survive, even small disruptions become dangerous. And that's why this kind of debt doesn't bend. It snaps. Between pressure and capacity. Pause for a moment and imagine a quiet shift. Nothing dramatic changes. Your job stays the same. Your routine stays the same. But suddenly you have access to a meaningful amount of cash at a low, predictable cost. No emergency, no deadline, just liquidity sitting there. What would you do first? One option feels natural. Use it right away, fix friction, upgrade comfort, make life easier now. Another option feels bold. Push harder, take on more. Use the access to accelerate growth before the window closes. Both feel reasonable. Both feel justified in the moment. Then there's a third path that rarely gets talked about. You wait. You don't deploy the money immediately. You let it sit. Not because you're unsure, but because you understand what flexibility actually represents. Which of those feels closest to your instinct? This pause reveals something important. When money arrives without urgency, it tests how you handle freedom, not pressure. Immediate use often converts flexibility into new obligations. Aggressive expansion increases exposure before stability is built. Restraint preserves capacity. This is where debt quietly changes character. The risk isn't borrowing, it's how fast access turns into commitment. And that instinct, what you do when pressure disappears, is the line between the structure we've been discussing and the one we're about to step into next. How debt works for most people. For most people, debt isn't used to unlock opportunity. It's used to smooth life. A car to get to work. A house to feel stable. A credit card to bridge the gap when expenses run ahead of cash. None of that sounds reckless. It sounds practical. The problem shows up in what those loans are tied to. Cars lose value every year. Credit card purchases disappear the moment they're made. Even housing for many households locks cash into a single illiquid asset while monthly payments stay fixed. The debt stays solid. The value underneath it often doesn't. Then there's the payment cycle. These loans don't wait. Every month, principal and interest are due on schedule regardless of what your income did that month. Overtime disappears, bonuses dry up, hours get cut. The payment doesn't care, and the money used to service this debt has already been taxed. You earn it, income tax takes a cut, and only then does the bank get paid. That means you're feeding the loan with your most expensive dollars. Here's the quiet trap. Because the assets don't grow fast enough, the debt never feels lighter. You work harder, earn more, yet the pressure stays constant. It looks like progress on the surface, but underneath the structure hasn't improved at all. The core imbalance that breaks regular borrowers. The breaking point isn't how much debt someone has. It's the ratio between what they owe and what they actually own. For most borrowers, that balance starts upside down. The debt is large, the assets are small. Income becomes the only thing holding everything together. Lose the income, and there's nothing underneath to absorb the shock. This is why the bank quietly stays in control. Until the final payment clears, the house isn't really yours. The car isn't really yours. You're effectively renting both from the lender month by month. Miss enough payments and ownership snaps back instantly. That imbalance shapes every term of the loan. High interest rates exist because the bank knows there's very little buffer. Strict repayment schedules exist because time increases risk. Flexibility doesn't show up when the borrower has no leverage. Here's the subtle part. As long as income keeps coming in, everything looks fine. Statements arrive, payments clear. Life feels stable, but stability is borrowed, not owned. The danger isn't visible during good months. It appears during the first disruption, a job change, a health issue, a recession. When income slows, there's nothing else to lean on. And that's when people realize the system was never balanced to begin with. How the wealthy borrow differently. Wealthy borrowers don't walk into a bank asking for permission. They walk in with proof. The key difference is scale and proportion. Instead of borrowing because they need money, they borrow despite already having it. If someone owns $50 million in assets and borrows $5 million, the loan isn't a lifeline. It's a rounding error. From the bank's perspective, this changes everything. The question isn't whether the borrower can make the payment next month. It's whether the collateral comfortably covers the loan, even if markets move against them. In that scenario, the bank isn't exposed. It's protected. That's why interest rates drop. That's why repayment terms soften. And that's why flexibility suddenly appears. The borrower isn't risky because they owe money. They're safe because they own far more than they borrow. Notice the contrast. A high-income earner with little net worth is evaluated on future behavior. A wealthy borrower is evaluated on existing ownership. One depends on consistency. The other depends on structure. This is also why wealthy borrowers can wait. They're not forced to sell assets at the wrong time. They're not pressured by monthly principal payments. Time works for them, not against them. And once borrowing becomes a tool for liquidity instead of survival, the entire debt conversation quietly flips direction. Asset-backed loan mechanics. Once loans are backed by assets, the mechanics change in ways most people never experience. Start with the ratio. Wealthy borrowers keep loan to value extremely low. Borrowing $10 million against $50 million in assets isn't aggressive. To a private bank, that's conservative. Even a major market drop still leaves a wide safety margin. Then comes the structure. These loans are often interest only. There's no forced principal paydown every month. You're not racing the clock. You're simply paying for access to liquidity, while the assets remain untouched and continue to compound. Here's the part that surprises people. Borrowed money isn't income. it isn't taxed. When cash arrives from an asset-backed loan, it doesn't trigger income tax, capital gains tax, or payroll tax. It's just temporary liquidity secured by ownership. So instead of selling assets, shrinking future upside, and handing a large percentage to taxes, the borrower keeps everything intact and pays a relatively small annual interest cost. In one example, a $10 million loan at 3% requires about $300,000 a year. That's the price of time, and time matters. While the loan sits quietly in the background, inflation erodes its real value, and assets do what they've historically done over long periods: grow. This is where debt stops feeling heavy, not because it disappears, but because it stops demanding urgency. The concept of never intending to repay. This is the part that feels wrong the first time you hear it. Wealthy borrowers don't take loans with a payoff date in mind. They take them with continuity in mind. For most people, a loan is a countdown. Every payment pushes you closer to zero. Miss enough, and everything unravels. For asset-backed borrowers, the loan isn't a race. It's a standing agreement. As long as the collateral stays strong, the loan simply exists. That's why interest only matters. When you're not forced to reduce principal, cash flow pressure drops dramatically. The borrower decides when or if principal ever gets touched. The bank doesn't mind because the risk is already contained. Here's where it gets interesting. When the loan term ends, repayment isn't required in the way most people imagine. The loan is refinanced. A new loan closes the old one. The principal rolls forward. Nothing dramatic happens. Selling assets would be the expensive option. It triggers taxes, shrinks the portfolio, and permanently reduces future growth. Refinancing does none of that. It keeps ownership intact and liquidity flowing. So the debt doesn't disappear. It also doesn't tighten. It just stays proportional. And over long stretches of time, that quiet stability ends up being far more powerful than aggressively trying to be debt-free at all costs. Refinancing instead of selling. When a large loan comes due, most people imagine a stressful moment, a deadline, a scramble, a forced decision. That's not how this works at the top. As the loan approaches maturity, the borrower looks at the asset base, not the calendar. If the assets are still there and still valuable, the solution is simple. The loan is refinanced. A new loan replaces the old one. The principal doesn't vanish. It rolls forward. Compare that to selling. To net $10 million after taxes, you might need to sell $15 or even $20 million worth of assets depending on tax rates. That's not just a one-time hit. It permanently removes future growth. You're not just losing money today. You're losing what that money would have become. Refinancing avoids that entirely. The borrower keeps the assets intact and pays a relatively small interest cost each year. Inflation quietly helps by shrinking the real value of the debt over time, while the assets sit on the other side of that equation. Here's the quiet advantage. Refinancing doesn't require perfect timing. There's no pressure to sell during downturns or bad markets. Liquidity stays available, even when prices fluctuate. So the choice isn't debt versus no debt. It's continuity versus interruption. And for borrowers with strong balance sheets, continuity almost always wins. Risk control through conservative leverage. This strategy only works because risk is controlled long before it becomes visible. Wealthy borrowers don't push leverage to the edge. They borrow a small fraction of what they own. That low loan-to-value ratio is the safety net. If markets fall, there's room to absorb the shock without triggering forced action. Prices can move. Cash flow can fluctuate. The structure stays intact. The assets themselves matter too. These loans aren't backed by collectibles or trends. They're backed by productive things, diversified portfolios, income-producing real estate operating businesses, land. Assets that may swing but rarely go to zero. Over long periods, they tend to grow. Banks watch this closely. Collateral isn't checked once and forgotten. It's monitored continuously. If values drop, banks act early, adjusting terms, requesting small changes long before a situation becomes dangerous. That's not panic. That's design. This is why asset-backed loan failures at the individual level are rare. When they do happen, they're usually tied to global leverage events that make headlines, not everyday market noise. The quiet discipline is borrowing conservatively when you could borrow more. That restraint is what keeps the system stable. And stability over decades turns out to be far more powerful than speed. The endgame death and tax reset. This is where the strategy quietly completes itself. As long as assets aren't sold during life, their gains remain unrealized. That matters because unrealized gains aren't taxed. On paper, the portfolio keeps growing, loans keep rolling, and nothing forces a tax event. Then ownership transfers. At death, asset values reset to current market prices. A property bought decades ago for $1 million, but worth $10 million today, is now treated as if it was always worth $10 million. The accumulated gain disappears from the tax record. That single reset changes everything. Heirs can sell assets immediately without paying capital gains tax because no gain technically exists. If there's an outstanding loan, they sell just enough assets to cover it. That sale isn't taxed either. So the loan that funded decades of living expenses gets closed cleanly without triggering the taxes that selling earlier would have caused. The remaining assets stay intact. Ownership continues. The structure survives the handoff. And often it doesn't even end there. The next generation borrows again using the same assets under the same rules. Not because of clever tricks, but because the system rewards ownership patience and balance sheet strength. What looks like endless debt from the outside is in reality a long sequence of controlled transitions, quiet, legal, and remarkably durable across time. Key takeaways. What separates debt that destroys from debt that compounds isn't discipline or intelligence, it's structure. Most people experience debt as pressure because it depends on future income, fixed payments, and assets that don't grow fast enough to absorb shocks. The system is fragile by design, and even small disruptions expose that weakness. For the wealthy, debt plays a different role. It isn't a burden to eliminate. It's a liquidity layer built on ownership. When loans are backed by appreciating assets kept at conservative ratios and structured for flexibility, time stops being the enemy. Taxes are delayed, forced, selling is avoided, and optionality is preserved. The deeper lesson isn't to copy tactics prematurely. It's to recognize what banks actually reward: stability, recoverability, and restraint. Ownership changes how risk is priced. Proportion matters more than speed. And patience, when embedded into structure, quietly outperforms urgency over decades. If this way of thinking reshapes how you see money, debt, and risk, stay curious. The most important shifts happen when you stop optimizing for short-term comfort and start paying attention to how systems behave over time.